Hello, and welcome to a new episode of Leadership Lanes. Today, we'll be talking about how to effectively value a pre seed stage startup with our guest, Shashank Deshpande, a seasoned designer, entrepreneur, and investor with over 30 years of experience in software products and services. As a co founder and chief business officer of Qubits, a collaborative design ops platform, while also spearheading early stage technology ventures as a managing partner at Pentathlon Ventures. He distinctly sits on both sides of the table as a founder and as an investor, which makes him a perfect guest for this episode. Welcome to the episode, Shashank.
Thanks, Abhijit. It's a pleasure to talk to you. And you've chosen a very interesting topic of pre-seed investment. So I'm very excited and I look forward to having a good conversation with you today. Thanks.
Great, really looking forward for it. So to start with, right, and this typically is in the pre-seed stage, or you can say like post friends and family round, is a
Hmm.
time
Hmm.
where there are no real sales for a startup.
Yeah.
And during this phase, how does one typically determine the correct valuation of a startup? What are the factors you determine at this stage when you are trying to evaluate a startup?
Yeah. When the company is at idea stage or you've built some prototypes or you created a proof of concept at a very early stage, it's very hard to value your startup. However, people have come up with very interesting models. I think one of the most popular ones is the SAFE agreement, which is essentially you are giving a discount to your current investors or your early investors based on how your future funding happens. So let's say if you're going to raise this in next 12 months or 18 months, whatever money you raise or whatever money you're able to raise at a valuation, you'll give a certain percentage of discount to the current investors. And that has sort of been one of the most popular ones. However, if someone is very keen on a fixed price or a price round, I typically suggest that okay, hey, how much do you want to dilute at this stage? So do you think you should dilute 10%? You should dilute 20%? So let's say if you're going to get an X amount of investment, and how much dilution you believe is a fair dilution. And again, these are not really data-driven or very qualitative approaches, but in some sense, people are okay saying, okay, or the investor sometimes is very keen that, okay, hey, I want a 10% of your business, I want a 20% of your business, because either he's coming as a strategic investor or he's coming as an investor where he really knows the thing. And those are the people who believe in the pre-seed stage, right? So that's one, and the last and the least preferred option would be that okay, you just agree to a certain valuation based on what you think. So either the percentage of dilution, or you just say okay, this is a valuation, and it's a fair bet. You've seen some parallels or some examples of companies being valued at that stage in a similar type of a company or a similar sector of a company. So those are, I would suggest, other options to look at pre-seed valuations.
Got it. You bought the discussion about safe, and typically now, I don't know which side of the table I'm talking to here, but in your opinion, or what do investors typically prefer? Because safe is like it is a promise given on a condition that you will go and raise a certain amount of money whenever you raise it the next time. Um,
That's it. Yeah.
so, does this typically happen in a way wherein there is some amount of money given upfront in the
Mhm.
pre-seed round, and then there is also a safe note which is given along with it, so that the investors kind of hedge their bets on the
Yeah,
fact that there will be some movement on the sales later on.
that's correct. Yeah, typically that's how it happens that and I think some of the seasoned investors are okay with the safe, and I'm talking about seasoned investors both in the angel, because if you look at pre-seed, I think one of the things that happened is that you're most likely going to get investments from angel investors, right? So they sometimes tend to be new in the sense they have not invested, or they're not aggressive investors in other companies. So they don't understand the safe really well, because they're okay to say, okay, hey, I'm giving you X money and I want an X percentage of your business, right? So that is very clear because there is it's kind of a black and white. Whereas safe is a little gray till the future round happens. So I would say if for some of the newer angel investors, I think it's a little uncomforting that okay, I don't know how much I own, or I'm giving you some money, but I don't have anything. It's a promise that something is going to happen in the future. I think a very similar thing happens in even in the institutional case. I think institutional investors have seen that they would also prefer a price down if possible. But in some very rare cases, they'll agree to saying, okay, hey, we'll be okay with a safe note. But by and large, most institutional investors will ask for a fixed price down because they have to report this in their reporting to their LPs. Say, okay, hey, we've done this investment in a company, and this is the equity that we own in that.
Got it. Moving on to the next question, and this might be a bit more abstract, depends on how you take it. But from an investor perspective, right? I mean, you might be investing in more than one company. So, how do you
Mhm.
make sure that you align with the core values of the founder or founders? And how do you look out for the benefit of both from a founder perspective and from an investor perspective, typically at an pre-seed stage startup?
I'm only going to talk about pre-sale because I think that's the.
Yes, yes.
I think the only thing that you bet really is the founder because in pre-seed and we all talk about that startups take multiple pivots in their journey, right? So you have to really have a good vibes about the founder and that okay, hey, he is smart enough. He has the founding team actually has what it takes to build a startup because it's not an easy journey of 0 to 1, right? It's always a journey. So there'll be challenges in building the product. There'll be challenges of going to the market. There'll be challenges in sort of managing a limited amount of resources that you have, et cetera, et cetera. And many of these founders have left some very cushy jobs and come. So you have to really bet on the founder. But there's no right or wrong way to judge a founder. I think it's just having multiple conversations that would lead you to get some confidence about the founding team, especially the well-roundedness of their founding team and the chemistry between them and how long they've known with each other. So there are several factors that we see both as an investor and even as an individual investor or an angel investor in multiple companies. And how good is the founding team? How passionate are they about solving the problem? How deep is their understanding of their problem? What is the pedigree that they bring into the table in terms of either their past experience or their educational credentials, etc. There's also a little bit of this okay here, how tenacious they have been before they have to come to this piece. It's not like they have an idea and then they've come to you. So they've done some homework, they've done some few things. So I personally value the founding team the highest in terms of I mean I may not be very convinced about the market, I may not be convinced about the technology or the idea, but I think it's about the founding team that they know the problem that they're solving. And I'm pretty confident that they may have to take some pivots and they may have to take do course correction in their journey. But that's typically what I value.
It was interesting because I was coming to the next question that do you, and this is typically a lot of investors get asked is do you bet on the founder or do you bet on the idea? But I guess you answered that question.
Now, when you talk
So
about a founder, Abhijit, I mean, at a pre-seed, I think idea. I mean, they may have a vision, which I think you should definitely understand that okay, they want to solve some bigger problem. Now, idea may have strength and it may do some course correction, but it is all about the founding team, and especially the well-roundedness of the content. It's not that three engineers came together and did something, but okay, do they have a good salesperson? Do they have a good technology person? Do they have a good operations person, etc., etc. I also we also look at whether their roles are very clearly understood and divided. That okay, someone is actually really the like a CEO of the person, so he knows what the company is doing. Then there's a person who is like a chief product officer, a chief technology officer. He really knows what the product or the technology they're going to build. there's a person who really understands the sales side of things, marketing side of things. So those roles also need to be understood. So I mean, I also get very uncomfortable when people say, no, no, I do everything, which is not. I mean, of course, you'll have to do everything, but there is a primary responsibility, and then there are a set of secondary responsibilities that every founding team has. But who's the primary driver or a primary owner of that activity, and he have or her to really drive that function very well.
That is an interesting take, which actually was my next question. And typically, when you ask investors this question, they always prefer to invest in a co-founding kind of a setup as opposed to someone who's a solo founder. At least that is the perception that as a founder you get. What is your take on that? Is this true? And probably you answered why, but is this a fact that investors prefer a
Yeah.
team rather than solo?
It's a fact, and I can tell you from my limited experience, it's all about risk mitigation, right? I mean, having a single founder so becomes a single point of failure.
Mhm.
So it's always challenge. And I can tell you from my experience, having a good co-founder in a company is really really helps you. I mean, and you've seen my journey at Clarus, right?
Yes,
I mean,
yes,
me and
yeah,
Sandeep, right, really had two complementary skills who we brought it to the table, and that's what made it really where it went. So and similarly, when we're running Pentathlon Ventures right now, I think that's really so there are people who bringing multiple strengths to the table, and that's how we take a call on whether to invest or not to invest in a company. So yeah, I mean, I think it's about de-risking. It's about having a team that can share your workload and helping you in areas which are not your natural strengths. All those things are very important. So as an institutional investor, we give a lot of importance to having a well-rounded team rather than a solo founder. I mean, we've also seen this that where people have come and formed founding teams at some later point or at some juncture when either things are either very good or things are not good. There always been differences on how they should. We have to also guard ourselves against that. So we typically ask all the founding team members to sign a founders agreement. So in case someone he or she decides to leave, what are the conditions that that person leaves? And I've seen that many really very established founders don't do this very well, having a founders agreement early in their. I mean, I think the first thing is before they start or after they start the company, I think they should put a founders agreement in place so that if things don't go well within the founding team or if things don't align in terms of how you want to mm, to take the company in a particular direction, there is some agreement of how to part ways in a very nice manner.
got it. From an investor perspective, I certainly can resonate as to why they prefer a founding team more from a risk perspective, for sure. Yeah, especially when the stakes are so high, when a lot of founders have left their
Stakes are
jobs
very high.
and
Yeah, then I think the other thing is having additional shoulders to uh, take some burden off. I think is also a big thing. It's not. I mean, there's so many things that you have to look at. Raising money, customer traction, building technology, building product. So it's a multiple things, and you have to deal with several things. So having additional bandwidth, leadership bandwidth, is very important. And I think this whole subject of how to get a right co-founder. I mean, if you ask me, I meet a lot of very very bright individuals, and I think they have some really good ideas, and they want to do this. So I think the first thing I tell them that okay, you have to find a co-founder. See, if you're passionate about your problem, you're passionate about solving something, you will you'll find customers or you'll find money. You should also be able to find a good co-founder. I've seen too many this thing just doing it solo, and you run out of steam, or you would run out of steam. So
I do resonate that, and I do agree with you that you run out of steam after a few years for sure. Yeah.
yeah, yeah. I mean,
Uh,
you just need to have physical energy, mental energy to run a company, and it's not easy. I can tell you that from my experience.
Got it. Totally agree. Uh, my next question was more from a founder perspective again. So
Mhm.
how do you from a founder perspective, how do they kind of avoid the enticement of pricing the company too high? We see, typically we see a lot of companies come in. I mean, I'm probably not a great example of Shark Tank, but just for discussion purposes, we see a lot of companies coming up in Shark Tank with crazy high valuations and not so great sales, or maybe just very initial stages of the company. Uh, so how do you kind of, from an investor and from a founder perspective, kind of avoid that enticement of pricing it too high at the very initial stages of the company?
This can happen on both sides, from the investors or from the founders, is to raise money at a very high valuation. Founders are pushing for a high valuation, investors agreeing to that valuation. Because if you at some point, you will the market reality will hit you, right? So you may raise a pre-seed money at a very very high valuation, but then you're going to move from pre-seed to seed to maybe a series A and beyond. So at some point, you'll start getting compared with what where the market is, right? There are going to be similar companies in a similar space which are either publicly listed or unlisted, and there's a lot of data that's available with the investors. So if you raise at a very high valuation at a pre-seed or seed, then it's going to get much harder to keep up with that valuation, or the investors will not see much of appreciation in the next stage, assuming that things go well. And things then don't go well, then you are actually even in a deeper soup. So you would get into this of down round or so I would encourage a lot of this thing to price it right, and also not to raise a lot of money in the initial, unless it requires that kind of capital. But you have to see that, okay, hey, after 3 or 4 rounds, there should be some sort of a projection that you should be able to create, saying, okay, seed stage, if I raise so much, then seed stage I raise so much, seed stage in 3 4 rounds, how much dilution will happen at each of these stages, how much appreciation I'm potentially should be giving it to my earlier investors. And very early pre-seed investors look at some sort of exit at a Series A or a Series B, and you should be able to provide that exit to these early investors. I would strongly, and this will have to discuss case to case, but strongly urge companies to kind of keep valuations at a very reasonable pace, and not push that. So, and I'm glad that in last maybe about a year or so, there's a good course correction that has happened. In my opinion, a very positive thing for both investors as well as the founders, that you've been able to get much saner valuations rather than some crazy valuations.
Well, yeah, I mean, 2021 did see some, I mean,
Yeah, some crazy things. Yeah, yeah, and even the if you look at the SaaS index, which is sort of a publicly listed SaaS companies. They were being valued at, I think, something like crazy at some point it went to about 16 or 18 times. Now, I think it is at a level where it might be at 7 or 8. And this is the publicly data available in the public domain, where they take about some 8 10 publicly listed SaaS companies. And I'm just taking SaaS as an example because that's something that I understand. But there's a very similar data available for multiple other companies where in 2021, very big 21 and most of 22 as well. I think after 23, they've come down and got to much better levels now.
Do you think similar thing has happened with EdTech as well? Because I mean, I won't take names, but has like extreme or insane valuations made it more difficult for them to sustain? And then now we see that not just a few, most of them are not doing that great post 2021.
Yeah, I mean, I think what has happened is that, I mean, sometimes it's kind of surprising. Investors were able to value these companies based on some crazy growth that they had seen in last few years, right? Now, what would that growth remain consistent? Was this growth on steroids? Was it there's like a massive marketing engine, celebrity endorsements, and all that pushing that growth? Investors would give you high valuation, especially if your revenues are high and growth is very high. So assuming that they were decent revenues and people are valuing the growth, it was interesting to see whether that growth will continue. I think these are some very basic questions that I think many investors should have asked. Okay, is will this growth continue, and would you be able to do this consistently, or at least what could be the projection? I think that's where things went really wrong. I guess that chasing growth at all costs is not a smart strategy in market. I think building a startup, building a company takes time, and it's patient capital. So you have to put in money, wait for it, let it grow at its own pace. Of course, you have to do everything that you need to do, but just having a massive marketing engine driving that, in my opinion, is not the right strategy. I mean, you can't put this on steroids and just expect that this will just take off. There'll be some natural equilibrium that it will hit at some point.
Yeah, well, that does answer the question. As a parent, I can totally foresee the marketing efforts that these companies had put for sure, especially in the tech space. And they did get a lot of
Yeah,
sales
traction as well.
during the
Yeah, yeah, yeah.
COVID era. But I believe post-COVID is where they kind of
That's right. Right. So a lot of those things are there. I mean, whether this growth will continue, whether this growth is plausible in a post-COVID scenario, etc. So yeah, those are the questions that I think any sensible investor, I mean, I don't no disrespect to, because these are all some very big names and very big companies. But I'm also quite surprised that no one asked this question.
the next point is something from a capital perspective, right? As an investor, how do you see some of the capital intensive startups? And typically, there are quite a few startups in the IoT space also that has come up. And typically, when it involves hardware manufacturing,
Mhm.
these are capital intensive businesses. So, as investors, are you averse to these kind of startups, or you think and this can be from an India perspective as well.
Yeah.
You can answer from an India perspective as well.
No, I think I mean I can very specifically talk about the India context, because that's what I'm. I think it's very hard to raise money for a very capital intensive kind of venture. So we've seen some ventures in past where they were building medical devices. There are also some ventures that we have seen where they're building these agro robots, where we should go and do some work in the agri. Now, it requires a huge amount of capital to set up a manufacturing line, or but even do contract manufacturing of these equipment, because it's very capital intensive. Because that building business, building a product is just like maybe 20-25% of your cost, right? The 75% of the cost is in marketing,
Yeah.
sales, partnerships, channels, etc. If you're raising X money, we expect all that X money to really go in sales and marketing and getting customer traction, rather than getting into building these manufacturing side of things. So we typically encourage people saying, okay, hey, look at how you can get this on contract and all. But it's not easy. I mean, that whole supply chain, especially in India, is not very well established. So you will always have challenges. And I've not seen the set of VCs or the set of investors that I know have done any significant capital intensive investments. Have not seen that so much. Most of this is B2C, where they're actually building a brand into some consumer space, or it's in B2B, where they're building a tech product or a SaaS product or a IT product, AI-based product. So those are where the most of the investments. But again, I have a very limited view of this thing. So if you talk to more people, I mean, you may get a better view of this. But from my limited perspective, I think what I've seen, and I'm talking about areas from Pune, Bangalore, maybe even some parts of Delhi, that raising money for a very capital intensive products or ideas is quite hard in India.
That makes sense. So moving on to the next question. So what is the ideal ROI or time frame that an investor would love to have when it comes to like getting back that investment? You partially answered your question wherein you said pre-seed and then they look out to exit in the Series A or the Series B round. But in general, when you are from an angel or from an institutional perspective, what is the frequency that you see to get that cash flow as well?
I'll speak from two perspectives. So, one, as an angel investor, I think the average time frame a good angel investor will have is about 5 years or 5 to 6 years. I think you should be able to give them some returns in 5 to 6 years. At least get a partial exit so that they can get the capital and maybe still wait for some upside for the remaining amount. As an institutional investor, they are bound with some regulatory promises that they make. So in their private placement document, they write saying, okay, hey, our fund is going to be 8-year fund or a 6-year fund, and they can extend it by 1+1. So the 6-year fund can become 8-year, and 8-year fund can become 10-year. I think the norm most funds that have is about 10 years. So 8 years as what is in the document, and then you can through super majority you can extend it by another 1+1, two more years. Um, and I think that's a good enough time for any startup to see if it's gone to some level in terms of, they've crossed the chasm of, BEC and now going beyond that. What also typically happens that early stage investors typically get some returns in their Series A or Series B or Series C, because when these Series B, Series C players come in, they'll come up with a very large checks, and and what that means is that they want like a big chunk of the equity. So they're looking at like some 10% or 20% or 25%. So there's some target that they have. And when you need such large equity or a substantial equity in a company, then it is quite natural that the founders don't want to dilute so much. So the only option that remains is to go to these early investors, either institutional or angel, and say, okay, hey, do you want to exit at this stage? And if the valuation is good, I think typically we have seen that investors are okay to exit, either do a partial exit or maybe a full exit. So yeah, I mean, I think there are forces at play where if the company goes to Series B, Series C, and beyond, the investors who come at the later stage will want a sizable ownership. And for that sizable ownership, the option is for founder to dilute or everyone to dilute, or get some secondary exits from the early stage investors.
That's interesting because that was my next question is what, in your opinion, or what pattern do you see that founders are ready to kind of part away at a pre-seed stage? How much equity typically founders are comfortable parting away with initially, actually, in the pre-seed stage?
It really depends. I mean, yeah, go
Sir,
ahead.
consider a team of say two co-founders, right? Just
Yeah,
a hypothetical example.
yeah. Uh, See, I mean, I'll give you a very different perspective. See, if this imagine there are two founders, right? And they have some idea, and I believe in that idea, let's say, and I want to invest. Now, if I can say, okay, I'm going to put some X money in your company, and I want 20% of it. That's in my opinion a very unreasonable demand, because I know that that company will go through 2, 3 rounds, and when it goes to 2, 3 rounds, the founder's equity will go beyond below 50, right? And then there's no point holding on to a very large equity where, first of all, you're sitting on the cap table where you just invested. So I think it has to be very reasonable investment, right? So assuming that the company will do very well. So even a little smaller equity in the long run should be able to give you a good return. And I think investors also, the founders also should communicate that value to them, saying, okay, hey, I mean, sitting on a very large equity, sitting on the cap table with very large equity doesn't help anywhere. And in any case, even with a little smaller piece of equity, if things go well, we should be able to give you a very decent return in 5 years or 6 years. And those returns could be like 10x minimum, but could be 20x, 30x kind of thing, which is a decent for any person who's taken some early bets. It's about the maturity of the investor, I would say. Of typically, I've seen that people just go in and say, okay, I want some 40% equity, 50% equity at a very early stage. I think it's very counterproductive in my opinion. What are you going to do sitting on such a large equity on a cap table? Uh, you're not helping the company at all. You're actually making that company uninvestable in market.
Mm.
So look at a smaller equity, but bet that okay, this will grow.
Got it. Got it. Got it. Since we are talking about equity distribution, and this is not from an investor perspective, but from a founder perspective, and I've
Mhm,
seen various versions of this, how to
mhm.
distribute equity among the co-founders. And
Okay.
there are a lot of online models available where you can put in what co-founder will be responsible for what, and it spits out an equity wherein eventually I've seen, or most of the times I've seen, the technical person ends up with 10 or more than less than 10% of the equity. Or what Y Combinator also suggests is to distribute it equally among the founding teams.
Yeah. Yeah.
What is your take on that?
No, no, I'm a big fan of so there's one thing about saying, okay, hey, I'm getting a person who is like head of technology, let's say, or head of products. Okay. But I'm bringing someone as head of technology, but he's the co-founder of the company. Okay. So when you give someone the co-founder title, and then I think he's just not responsible for technology. He's responsible, equally responsible to ensure that the company is successful. So there might be things that he may have to do in marketing or sales or investor relationships or maybe customer traction, operation, whatever, right? So when you get into when you give someone a title of a co-founder, then that person is equally responsible for the success or failure of the company. So in that sense, I would say I'm a strong proponent of saying, okay, everyone should be equal, especially if you're starting at the same time. Now, many other cases, so happens that someone starts with the idea, he builds some prototype, he gets some initial traction, and then he says, okay, let me get some chief of product, or like, let me get some sales guy, etc. And then there is a little bit of lag in that, and in that sense, there could be some lower or higher equity. But if you're starting at the same time, everyone should be equal. Everyone should be pulling together in the same. I think this will be different only in case people join at different point of time, and there's some traction or there's some value that is built before a person joins, and to that extent, then the new person who joins as a co-founder should be discounted.
Got it. Got it. Thanks a lot, Shashank. I guess we are almost time over here. It was great having you, Shashank, and thanks a lot again for coming and talking about this today.
My pleasure. Abhijit. So good, and wish you all the best.
Absolutely, absolutely. Thanks a lot, Shashank. Thanks a lot.